Exercise 22-7 is an example of what is sometimes dramatically called a keep or kill decision. Well, relax, nobody's actually going to die here, but given this income statement for two departments for the acoustical guitar company or the wholesale guitar company, they have two departments. They have the acoustical department and the electric department. And when you compare the departments in a traditional income statement format, it looks like if you get rid of the electric department, you'll make more money. But I want to draw your attention to a couple of things. I want to draw your attention specifically to depreciation expense, rent expense, and utility expense. Those are allocated expenses like we did with the bookstore problem. And if we allocate those expenses, we can make the depreciation expense go away for the one department, but it's still going to be there. Somebody's going to have to pay it. The same with rent, same with utilities. And with any of these keep or kill decisions, you always have to be careful about the allocation and the allocated costs because they will not go away. So we're going to take this information and instead of putting it in a traditional income statement, we're going to take this information and move it to a contribution format. So we're going to have all the traceable or direct costs here. These are all of the allocated costs here. And we're going to take a look and see what happens because in reality, these costs don't belong to the acoustic department. They don't belong to the electric department, the electric guitar department. They do belong to the entire business. So let's see what happens. Let's do this. And let me put my cheat sheet up so I don't have to try to remember the numbers. I'm halfway done the first cup of coffee, but it's still not good enough. So I'm just going to go through and pick up these numbers and put them on our contribution margin statement. The sales for the acoustic department were $112,500, and the sales for the electric guitar department were $105,500. The cost of goods sold was $55,675 and $66,750 respectively. So the combined cost, I'll combine them out here because that's our check number. And like I said earlier, I need to be able to check those numbers because if you were in class with me the other night, you saw that I can't add for crap. Okay, so the gross profit is $56,825 for the acoustic department and $38,750. And if you add those together, fortunately they do add. So these combine, add, and then if we add this plus this, they add. So I haven't screwed up yet. Now, we're going to take the salaries expense, and again, they can be traced directly to the departments. So the salary expense, the supply expense, the ad expense, they can be traced. So because they can be traced, we'll trace them. The salary expense is $17,300 and $13,500. The depreciation expense for the direct equipment is $10,150 for the equipment used in the acoustic department and $9,000 for the equipment used in the electric department. And the supplies expense is $2,030 for supplies used in the acoustic guitar department and $1,700 for supplies used in the electric guitar department. So the total direct expenses, the expenses we can trace directly to those departments, is $29,480 and $24,200. And if you add these up and you add these across, you'll come up with the same number, $53,680. And they do add, honest. Okay, now, they're the total direct expenses. When we do that, we come up with the departmental contributions to overhead. How much they're contributing all together to overhead. Because that's what contribution margin says. What's available to pay fixed cost? Excuse me, and overhead is a fixed cost. So the contributions for the acoustic department are $27,345, and the contributions from the electric department are $14,550. And the combined contribution of both departments is $41,895. Now we're going to take a look at those common expenses, the rent expense, the utility expense, the advertising expense. I said depreciation. Now, if depreciation were on the building, it would be allocated. They're saying this depreciation can be traced, so it's traced to the building. So with depreciation, before you decide whether you trace it or allocate it, you have to decide depreciation on what. So, when we do that, we come up with taking the rent expense of $12.55. We come up with advertising expense of $55,595, or utility expense $55.95, and advertising expense of $14,325. So altogether, that's $9,920. Well, it's $31,995 or $31,975, excuse me. In total indirect expenses, $9,920 net income. I need to draw your attention right here. If we do away with the electric department, these costs will not go away. There may be a little less utilities. There may not be any change in advertising or rent, because the problem implies that the advertising is not traceable. It doesn't say advertising for electric, advertising for acoustic, so it's general brand advertising, the wholesale guitar company, we won't string you along, come buy our guitars on your own accord, whatever. So it asks us, should the electric guitar department be eliminated? Well, if you eliminate it, you're eliminating $14,000 worth of contribution. So I would say it should not be eliminated, because it does indeed contribute $14,550 to covering expenses. Once you allocated the expenses like they did in the traditional income statement, and this is the one that a lot of managers would say, no, that department's losing $200, get rid of it. But they are ignoring the fact that this cost, and this cost will not go away. That's the danger of allocatable cost. If you're going to stop a product, discontinue a segment, close a line of business, make sure which costs will be going away.